All right, everyone. Good morning, and thank you for joining us for our 48th EO Exchange. This morning, our Strategic Alliance partners, the City Living Group and Continuum Planning Partners, are going to provide a financial review of 2023 and guidance on how to position yourself in 2024. So let me introduce our incredible panel of SAP experts who will be presenting this morning. Deborah Vale with City Living Group at Village has a background in global sourcing and working with people across the globe to negotiate contracts worth hundreds of millions. Recently, Deborah became a host of American Dream TV, an Emmy-nominated lifestyle real estate show, streaming on Amazon and airing on the CW in Nashville. She has served on the EO Nashville Board, Nashville Area Short-Term Rental Association, and is currently board president of Web School, a popular homeschool tutorial based in East Nashville. She and EO member Matt Charette have 4 school-age children. Also, Mark Deutschman is an EO member and Strategic Alliance partner. Mark's sales focus and passion include all of Nashville's inner loop neighborhoods. Mark has sold thousands of homes in Hillsborough Village, 12th South, and other Nashville urban neighborhoods. Mark's team has sold over 50 condo, loft, cottage projects, Inc. Mark is the author of 1 Mile Radius, Building Community from the Core, which was published by Advantage in 2017. Mark has undergraduate degrees in zoology and Spanish and an MBA in international management. Mark and his wife, EO member Sherry, live in Hillsborough Village. Sherry Stewart Deutschman is also an avid entrepreneur. She's the founder of Letter Logic and Brain Trust. Mark and Sherry like to walk neighborhoods and greenways and enjoy traveling. Mark is an avid juggler, collects stamps, and enjoys river kayaking. With Continuum Planning Partners, we have Andy Fott, who's been a financial planner since 1999. Andy graduated magna cum laude from Lipscomb University with majors in, get this, finance, economics, and accounting. He is involved with the Martha O'Brien Center on the Finance Committee and is an active volunteer, as well as on the board of directors for East End Prep School, a charter school in East Nashville. Andy and his wife, Jennifer, live in Nashville with their 2 dogs, where he enjoys golfing, traveling, and the booming culinary scene. Abby Spalding is a Nashville native. She started as a financial planner in 2008 in Washington, D.C. In 2015, she founded Continuum Planning Partners. Abby is a Nashville Business Journal 40 Under 40 winner and was named 2017 Nashville Business Journal's Power Leaders in Finance Award. She is the board chair of a local charter school named Rocket Ship and sits on both the Harpeth Hall Alumni Board and Salvation Army Board. She is involved with the Nashville Rotary Club and is the past president of Women Engaging Business. Abby is married to her high school sweetheart, J.B. Spalding. They have 2 daughters, a tenacious 5-year-old and a sweet, cuddly 2-year-old. Thank you all for joining us today.
All right, appreciate it. So I need to update my bio a little bit. I guess I haven't updated that thing in a long time, which is that is. Thanks for pointing that out. That's good to know.
I almost shouted out nerd when he announced all your degrees. I wanted everyone to know.
Yeah, I love. Just wait till you see some of my slides. You all are going to see nerd come out pretty hardcore. Yeah, so I'm going to kick us off today. What we're really going to do is kind of look back at a few. Really, this is all about investing. Where to put your hard money to work, hard-earned money to work after you've built it in your business, and where do I put it after that? And what we're going to do is look back a little bit to 2023 and look forward at 2024 and where some opportunities might lie just based on that. And history, I'm going to talk a little bit about what's happened. Hindsight's always 2020, but history informs the future. And despite 2023 being a very challenging year, it was a very good year for a lot of markets and a very bad year for others. And if you look back at the beginning of 23, all the Wall Street talking heads, what they said would happen in the market, the liquid markets, we'll talk mostly about today on our side. They all would have said it was going to be a bad year. We were heading for recession, and much like weather people and fantasy football experts, their educated guess was very, very wrong. It was a fantastic year in the stock market. It was a interesting year in the bond market, with interest rates being so high and the ability to put money to work in money markets, earning reasonable rates of return for the first time, inflation coming back down. So we're going to look back a little bit on that and just see what did happen, and then how's that inform the future. So I'm going to share this. Can everybody see that? Deborah, Abby, I see you all thumbs up. Perfect.
Yep.
So this is looking back at the S&P 500 total performance for 2023. And what's kind of interesting about the S&P 500, even though it's the 500 largest stocks in the US, it is weighted more towards how often a stock is traded, which means there are about 7 stocks that really drove this performance. That's Apple, Amazon, Google, Nvidia, Microsoft, all the Tesla, the big tech names really drove this. So we have some kind of thoughts about what that might look like going forward. But if you invested $100 in the S&P 500 at the beginning of 2022, you'd have $127 at the end of the year. So again, despite all of the talk about the economy and where things were going, had a very good year in just the stock market in general. But what we want to do is take some historical perspective and look back on that. So what changed? And why was last year different than previous years? So these gray bars all show all of the S&P 500 returns since 1977. So, the first thing you'll notice is there are a lot above and a lot below the 0% line, but more above. But this blue line is 2022. So good year, but there have been better. But 22 is the orange line. Been worse, but not many. So we had a really, really interesting 22 that was a very scary time. And people tend to kind of have, we study a lot of behavioral finance, which is how people think about money. Money is not math and math is not money. And people think a little differently about it. And there's always a recency bias of, if the market did really terribly last year, it's going to do terrible forever. If the market did great last year, it's going to do great forever. And those really almost never come true. But then if we look at the bond market, nobody has paid attention to bonds for the last probably 10 years because interest rates have been so low. Why would you put your money in something paying you 2%? What's the point? There have to be other places to put money. Well, looking back at the average returns of the bond market since 1977, what you'll first notice is 2022 was the worst by far, by a very, very wide margin. 2023 was basically flat. And so Abby's going to talk here in a little bit about where some opportunities might be in a market that has been largely ignored the last several years. And then lastly is inflation. What really happened with inflation? We stuck here around this 2% for a long, long time. And then all of a sudden, here's COVID, where the government starts printing money and putting a ton of money into the economy. People have pent up demand and spending, and inflation spikes. Well, the Fed pulled the emergency brake on interest rates in order to try to reduce the money supply, which means people spend less money, which means inflation comes down. And so we've seen it come down to what is more of a reasonable place, but it's likely, if you look at just history and other times like this, it's likely to stay a little stubbornly higher than average for a while. So if the Fed wants it in the 2 to 2.5% range, we're probably going to see it in that 3 to 4% range, most likely. So they're talking a lot about potentially lowering rates this year, but we'll see what they actually do. They really want to see this come down a little bit further than it has. So with that, Abby, I may toss it to you.
Yeah. So we were joking before this that, I'm going to do the looking forwards and it's recorded. So you guys might, these are some of our predictions that we may look back on this video and find that are all wrong. But we always, like to Andy's point when we started, history doesn't necessarily repeat itself, but it does certainly rhyme. And so what you're looking at here is what has happened in the market after a Fed pause. And as we all know, everyone is watching what the Fed and particularly Jerome Powell is doing. This is looking back at the times that the Fed has paused rates. And first and foremost, one thing that I find interesting, we'll look at this also on the bond market, is it's only really happened 5 times. And so each one of these markets is actually very different. The economic circumstances here are all very different. But what's common is after the Fed has paused rates, here is what has happened in the market. So, and we've really felt that in the last, I'll call it 6 months, when the Fed started to pause rates. You can see, and we'll take 1995 as an easy example. The dark blue is the S&P and the light blue is the bond market. If you look at it, both the bond market and the equity market has been substantially up, mostly because everyone expects when there is a pause in the Fed that there will subsequently be a drop. And so what I mean by that is let's say the Fed next month drops rates. Well, the market has somewhat priced that in already. We have felt that recently, that we've had a big jump up. So everyone is expecting with a pause that there will be a drop eventually. In this market, especially due to the slide that Andy just showed you on where inflation is, we don't expect the Fed to drop rates quickly or dramatically. We expect them to drop rates slowly and steadily, because they're going to want to drop rates and see what the economy does. Is that pesky inflation going to rise again? This is completely my opinion. But you know, in the economists that we follow, there's some other people that agree with this. Although the Fed tries very hard to stay out of politics, I have a feeling they're going to try to drop rates as far away from November as they can, so that they can see what the economy is going to do and not let it be too close to election day. So late spring, early summer, I do think we'll see some movement, and we'll see again what happens in the economy and where the Fed's going to take it next. Which takes us to my next point. Yeah, I mean, if you want to switch slides here, a question we often get is, who is better for the economy and the markets, particularly in the White House? And so what you're looking back at is all the way to 1933, where when Democrats have been in power versus when Republicans have been in the White House. And basically, what we always like to tell people is it really doesn't matter. You can see there have been up years for both. There have been down segments for all of them. We even have, we don't have it here today, but we have some graphs that have shown, well, what if the Senate is blue and the House is red, or vice versa? And what about the combinations of those, of who's in power? And again, pundits like to say it matters, and newscasters like to try to get eyeballs on screens, but I'll tell you, it truly, from the data, doesn't matter. What is likely going to happen is it's going to be very volatile between now and as we ramp up towards November. So what you're looking at here is what happens in non-election years and what happens in election years. And you can see in election years, it's just a little bouncier. But what tends to, particularly as we find out who is going to be closer and closer to, you know, our two candidates, so to speak. And the other interesting thing to me on this is the markets just want certainty. And when there's uncertainty, like who's going to be elected, they get bouncy and they get really volatile. We always like to look at the 2016 election, and this is not a comment at all on that election. It's mostly a comment on the markets. But in general, people assumed that Hillary was going to be in the White House. And when Trump won, the markets that week fell because there was some uncertainty of what is going to, you know, this is an unexpected event. And then once everybody got their feet underneath them, they had certainty in what was going to happen. Markets corrected and went back right on track with what they're going to do. So if, you know, I say all that to say, don't let emotion drive your decisions. All of this really should kind of somewhat hold to say, invest in the long term, not letting your fear drive any anxiety of when to get in and out. Which really goes to this. We like to say this is our slide that is our pay to play slide. What you're looking at is returns all the way back to 1980. And the blue line is where the market ended, and the red dot is where the market, what the lowest point in the market was at that exact same year. So what's interesting here is there's again some blue lines that are down. There have been some years in the market, obviously, that were down. And you could look at that 2008 year where the line is way down and the bottom of the market was way down. But in general, what you can see is there are a lot more up blue lines here than down. But even in years like 2020 is a great example. In years like 2020, where we were down 34% that year, but finished 18% up. And if you had sold out at the bottom, you would have lost 38% versus holding on and ending 18% up. And, Warren Buffett always says, as an investing incentive, be greedy when others are fearful and fearful when others are greedy. If you got in at the bottom, you're going to ride up a very nice return versus being fearful and selling out. Or when the market is up 31%, trying to get in and trying to time the market. So to Andy's point on bonds, I'll finish up with this comment. We are looking here and a question we get all the time is, where should we put our money? And in the short term, and short term to us is really 18 to 24 months, bonds have a really great opportunity. Especially a lot of people have money that they're sitting in money markets. And money markets right now are doing great, 4%, oftentimes 4.5%. Well, bonds are also yielding 4%, but are, particularly if you're in Tennessee, tax-free. So it's really like 5% because you're not paying taxes on that yield. And what you're looking at here is when the bond market has been down, which is those down yellow bars, which again, to our first slide, has only been 5 times. The blue bars is what has happened the following year. So when bonds are trashed, in the gutter, you could see on average, the 5%, 2%, 8%, because bonds typically are not supposed to go down. But interest rates and bonds are inversely related, which means when interest rates go up, bonds go down. And we all believe, and the Fed has told us that bonds or interest rates are at their peak and they will come down. So bonds have to come up. What we like to say is if equities are an educated guess, bonds are a math problem. So I do think the 1982 return of almost 41% is somewhat misleading because interest rates were also at 16, 17, 18%. But if you look at a typical down year, the following year has been a really great return in the bond market. And as interest rates come down, your money markets will also come down. They are correlated to those rates, whereas these are going to slide in and ride up. So if you have a lot of cash that you're sitting on, even in your business, this slide, we use our friends who are also a strategic partner over at Alliance Bernstein. We utilize their strategies all the time. This is an Alliance Bernstein slide, actually. And they're liquid. They're not as liquid as money markets, but they're liquid in 3 business days and potentially have a really nice future going forward as we look at where the bond market could be. So if anybody doesn't have any questions on that, I'll pass it to Deborah. I'm happy to answer some questions if anybody has any.
I'm curious if I'm following what you just told me, given that I work with you and Andy. Just kidding. I hope so.
Got some bonds. Don't worry. Yeah.
Abby, this is Brad Hill. I have a question that you mentioned that you thought the rates would decline slowly, and I'm curious what you think. What does slowly mean?
That's a good question. With where everyone keeps talking about the soft landing, and trying to get, if they drop rates as quickly as they raise them, inflation likely will rise just as fast as it went down. And so what I mean slowly is I think the Fed will probably this year drop rates twice, 2 quarter points. Now that is literally my guess, but the Fed is likely going to drop a quarter point see what happens in the economy, make sure that it's stable. They could go up if inflation starts to rise again and it becomes an uncomfortable economic situation. But if it's stable, they'll drop one more quarter and see if they can keep inflation where it is. Now, 2025, I think they'll continue to drop, and you might see more escalation in 2025. But I mean, most of you, as business owners, you're all feeling it just as much as the what I would call the layman investor. But you all kind of have your finger on the pulse of the economy a little bit more than most. There still is a small drag. And hiring and getting the right people at the right price point is still an issue for employers. And they have to drop rates in conjunction with that, with where some of these commercial properties are and where some of those terms are falling out, where we can't have an economy where you have too many commercial properties going into bankruptcy and the Fed not even be able to pay its own bills. And so they will drop rates, but I do think that you're looking at a 2-year drop before, and I don't think we'll ever see the 2-3%. I think that's general consensus again in the next 20 to 30 years. But I do think you'll see, we'll settle out in the 4s and 5s more so than the 6, 7, 8s. Andy, anything to add to that?
Nope. Well said.
Rarely, but I'll take it.
Speaking of real estate and interest rates, Deborah?
I will share my screen. Good segue there. So I will just go through kind of similar to what Andy and Abby did. Mark and I will share kind of what we saw last year in real estate and then what we're seeing next, what we think we will see this year. So like Andy said, even though last year was challenging for people and the commentary was negative, our team, for instance, still sold $228 million in real estate last year. So last year in the single family market, if you look at the year over year column, that is going to show you, year over year from December to last December. And if you look at, we saw a lot more contracts being written towards the end of the year. We also saw inventory go up. The inventory had been down quite a bit last year. People kind of just froze. Once those interest rates started to go up, people stopped buying, they stopped selling. They weren't sure, sellers saw their homes sitting on the market longer, and so they pulled them off the market. And then buyers weren't sure what the rates were going to do, so they stopped looking, or they just no longer could afford what they wanted to buy. So we saw a lot of that last year. Despite that, again, we still had closings go up towards the end of last year. The sales price on average went up 17%. This is in Nashville, and the median sales price still went up. Days on the market were up, but if you've heard me talk about that before, so average days on market were 32. That's a pretty normal market. It was just our average days on market were so low the previous years. Average list price over $1 million. So that was another thing we saw last year. It was interesting that 700,000 and down price points. We saw a lot of that movement stop because that was the price point that if that was your buyer, then they were most affected by that interest rate going up, versus the buyer, the $1 million and up buyer may have been in a different position. They may have not have been getting a loan for the majority of that purchase. And then, your list of contract days went up a lot again, but what we saw here was that the lenders tightened down considerably. So for someone to get their loan closed, it would take longer on average than it had been in the previous year. Average months of supply so we had a little over 4 months of supply in single family homes. So that wasn't too much of a change. there. But then if I scroll down and show you the condo market, it looks a little different. We have 158%. We had a lot more condos hit the market. And that again is because on average, those price points were lower than the single family. So that buyer was more affected. With the inventory and the average sales price right here, where you see average sales price went down 37% on condos. One thing to remember is that the Four Seasons closed that previous year. So those average sales prices were so high that that's affecting that number a lot, because those were over $1 million price points, and your average really is closer to 500,000. Days on the market went up just the same as single family, but again, it was just 30 days average on the market, which is pretty normal. So when we talk about mortgage rates, like Abby was just speaking about, when we look at what they did last year, yes, they went up. They are coming back down, obviously, and we expect them to stay pretty stable and possibly come down a little bit this year. The uncertainty is what will affect the real estate market just as much as anything else. As Abby was saying, when you have uncertainty, people stop, they freeze, they're not sure what the right move is. So when we all kind of agree that, hey, the rates are stabilizing, they may come down a little bit, then people are going to be more comfortable coming back to the market. And anecdotally, we are already seeing that, with the buyers that we're working with. Mark, if you don't mind getting your crystal ball out and talking about 2024, I know that's your favorite thing to do.
So it's correct. I mean, the interest rate really froze the market in many places. It didn't seem to freeze the market in some of the existing neighborhoods. And again, there seems to be some, unbelievable transitional wealth happening. So a lot of people had a lot of money to invest in Belmont Hillsborough, 12 South, Richland Central. Those prices and houses just jumped off the shelves and have been amazing. But there was some slowdown in the under $700,000 market. We sort of expect now, with these next couple of drops in interest rates, that people are stepping out from the shadows, and we'll see a lot more activity here in late spring and summer, particularly in that marketplace where people have been just waiting for interest rates to come to a place where they think they are stable. And because it's been so hard for the developers to build projects because of high construction numbers and high interest rates, I think you'll see less inventory coming to the market. And so the inventory in those price points in some of the emerging neighborhoods near the stabilized neighborhoods will start being sold, and we'll see a balance come back to the market. Nashville's in a crazily enviable position because for the last 3 years, and again this year, we've been named the #1 emerging trends city in the United States. And back in 2008, when we started our chapter in Nashville, we were only in the top 50, but we've been on the rise. And even if it's been a tougher market for all cities, it's good to be in Nashville. I'm sure those people are looking at the East Bank, River North, a lot of the investment that's coming into Nashville, and saying, yes, we're in a better position than some of those other cities because we have a lot of economic growth. What I see is when people are hesitant to invest in real estate, they'll go back to the tried and true. And you can see 12 South right now, it's gung-ho and crazy, something I didn't see back when I started investing back in the late 90s and early O's. And all of the neighborhoods, which seemed like transitional neighborhoods in the past, are now those stable neighborhoods where the investment flows. But what I would encourage perhaps you to watch is some of those neighborhoods where the investment flow is ebbing might be those opportunities. So take a look at some of the neighborhoods that will be the next up and coming neighborhoods that might see a drop in investment for just this moment or for this place in the cycle. That's where I might go. And then I might, because I think in the terms of 1 mile radii, I look at the emerging walkable neighborhoods, sort of most recently Wedgwood, Houston, where we started investing in 2014 and 15. And now we have some other areas where we're investing where we think it's going to be the next hot neighborhood. But I would actually watch what happens in this year particularly, because we will have a transit referendum, and there's a possibility where you're going to see a lot of investment on the corridors. I don't know if you've heard of transit-oriented development, but where the market, you'll start seeing 1 mile radii transit stops, because you'll see investment come in and around places where people can get to work, where the workforce has an opportunity to buy into real estate without a car. But I'd also encourage you to watch what happens with greenways. This loop that you are looking at is the city central greenway, and it's going to go all around the city, and not much of it's yet built. And when you get into the urban core, like for instance, looking at some of the blue lines and some of the places, maybe if you're looking from Geodis, some of the orange lines at Browns Creek, those are very urban neighborhoods. And if you get a greenway, a lot of energy will flow to that area. Some of you probably remember when Don DePani was here, he said, where awareness goes, energy flows. Well, I say where transit goes, energy flows, and that's money in the marketplace. And you've seen cities like the Belt, Atlanta with the Belt Line, New York City with the High Line, Indianapolis with the Cultural Trail. When they've built really good urban greenway systems, the money has flowed, and people want to use greenways to get to walkable urban neighborhoods. They tend to go more often, stay longer, invest more. So take a look at what's happening with this transit referendum and think about where you want to put your real estate money this year.
And, we all talked, and we know that there's a lot of times a lot of questions come up. So we thought we'd just kind of open it up to question and answer for any of us who've spoken on the panel today. And that way we don't show you things that you don't care about. And if you have no questions, then Andy can tell us a joke.
Can you guys share the Greenway map?
Yep.
This is from my book, and it's ironic. I've just gotten, I just got put on the Greenways Commission, and that means I'm on Greenways for Nashville Board again. And then I've also been put on the Middle Tennessee Transit Alliance. So I'm going to be working pretty hard to make sure that when we have a transit referendum and we get some, big federal money to create some really great transit stops on some of our corridors like Gallatin, Dickerson, Nolensville, etc. I'll be looking to make sure that some of those monies go for multimodal transportation and the urban greenway system. It's really the cheapest form of transportation. It also is good for sustainability and takes cars off the road, but it will be it's a major investment opportunity. So keep your eyes out.
So what portion of that orange is already in place?
There's a little section there's a section of this city central greenway called the I-440 Greenway. And so you've got a little section that goes from West End over towards Centennial Park right now. I don't have a pointer, so I can't talk to you about it. But it's on the left-hand side right now, that last arrow that goes up and down. That's a small section, but we have easements right now to take that greenway and go all the way over to Franklin Road. And at Franklin Road, it would connect to the Browns Creek Greenway, which is so it's not even one of the 7 minor rivers in Nashville. It's a smaller river, and that goes down to Geodis. So that would go down to the soccer stadium and Nolensville Road. And then eventually it crosses Nolensville Road. It goes to Murfreesboro Road right at Sudicum Napier, which is one of the community housing projects that will probably be next after Casey Homes to be redeveloped. So that's very interesting in that location. And then it goes down to Hermitage and then drops into Rolling Mill Hill. The green is done. So there is a Rolling Mill Hill section of the Greenway that comes down across the riverfront and will go all the way around. It goes all the way down to Ted Rhodes Golf Course right now, but it will continue around behind TSU. It will come down into a section maybe you're familiar with, maybe not, into Boyd Park, and then it'll cut over 28th and cut back down to the 440 Greenway. The blue line that says rail with trails, that is in the works right now. There's the engineering's being done. We have $12 million from the city allocated for that greenway, and it will hopefully get started in 2024. We'll probably do a private fundraising to cap out and, hopefully be able to buy some more urban pocket park systems to go along with that greenway. But that's sort of a snapshot. You're going to have some pretty interesting greenway connections from Geodis that come back down towards Fort Negley and back into the city as well. So you'll see complete streets and greenways working well together, hopefully, that create a multimodal non-car transit system.
What's the timeline on completing that?
Well, it's 10 years, but it will be a lot faster if we get a transit referendum, because at least with this mayor who really believes in walk ped, a lot of the monies would be allocated for building this faster. And if it's up to me, I'm going to be pushing to get more money towards greenways, because I think it's probably the best way to get people moving. It's one of the healthiest way to keep people moving too. So the transit referendum, I'm thinking the mayor's going to announce that we will do that in the next 10 days. And then I would suggest that you guys take a look at it and make sure that you vote for transit this time. This is not going to be it's not going to be like it was back in 2018. It won't have a tunnel underground. There shouldn't be the same kind of resistance. I think there is a pent-up demand for better mobility in the urban core, and that gets us out. We're a spoke and hub system. It gets us out towards the airport and gets us out towards some of the neighborhoods that are emerging.
So Mark, the last transit referendum they stubbed out rail lines halfway to the county line. It didn't really address incoming traffic. Do you foresee this one having a greater reach and having more impact on traffic coming into the county?
My gut is it will, but it will be not, I don't know that necessarily it will be on the interstates. I think it will be more on the corridors. That's my gut, but I don't know for a fact. There's a team that's putting this together. The mayor just took in a person named Michael Briggs. He used to be in the mayor's office, but he's helping out the sustainability initiative. You've got WeGo looking at it. You've got Aaron Hoffenschild of Think Tennessee looking at it. So I'm not sure what the proposal will include, but my gut is that it will help with incoming traffic, but it will help more on the corridors than it will on the interstates.
So the state and Butch Ely have been pushing choice lanes, and that seems to be that's a foregone conclusion. Are they working together with the city to plan together on that?
Good question. I think that's what we need to do, is make sure they do. I am certain that they're talking, but I'm not sure how this referendum will play with, the state and TDOT and how that will align. I hope it does, because, there's so much work that needs to be done with our interstate system too.
I actually sent a note for Michael Briggs yesterday, because I would love to, as this unfolds, I'd love to have a chance for them to present to EO, kind of like the Titans did, and learn more about what the plan is, because it's such a huge deal for Nashville.
We just had him present to the Urban Land Institute last week. And so there was a group, it's, Diane Alcarone of NDOT, you've got, you've got different groups that are going to be involved in this that you could get on a panel, and it would be an important discussion.
So Daniel Woods would like to know more about real estate around Geodis Park and surrounding areas, future growth potential.
Who wants to talk about that?
There's a lot of stuff happening out there. We have the Alloy development that of course Core developed a few years ago that overlooks. You can see Geodis from Alloy, and definitely the WeHo area is seeing a lot of growth. We have a new development there called Maslow that's being built right now. So there's still a lot of growth happening over there. Are you
Yeah,
wanting to know about like land or?
everything in the Wedgwood Houston neighborhood, almost out to Geodis, is still in an opportunity zone. And so you've seen an immense amount of investment coming into Wedgwood Houston proper, so down towards where the Soho House is located. And a lot of it has been opportunity zone money that's taking advantage of those, tax opportunities. That comes out really on Nolensville Road right to about Geodis, but not beyond. But then you look at that corridor, you look at the Nolensville corridor heading out to 440, and it's really still pretty a car-centric, like a lot of our corridors, it's car-centric, and you have to start looking and seeing where those transit stops are going to be along Nolensville Road. Nolensville Road between, I think, Haywood and Harding just got $13 million to do some smart street work. And I wouldn't assume that includes bike lanes and pedestrian safety and transit stops. So you're seeing it start to build even further out in that fast growing segment of Nashville. But if you're looking in and around Geodis, then you have Browns Creek, which comes in through Berry Hill and that whole segment, which seems to be getting some great music investment, among other things. And, that's a good area to watch. But then anything between Geodis and, if you look at the opposite side of Geodis from, Bransford and all that area in between, it seems to be having some increased momentum for, mixed use and urban development. I think that's going to be an interesting area to watch as well. Chestnut's going to get a bike lane, so that's that's going to take you over to Murfreesboro Road, and then over to Vanderbilt University. That should be pretty interesting as well.
So Chris Corby's already perused your book looking for the map and he can't find it. So there's that really piqued everybody's interest, and we'd love to if somehow we can make that available for everyone.
Okay, I'll try to get that. But there's better maps now, and I think I've been advocating for a much better mapping system that shows complete streets and greenways all in one package. And I think it's happening through planning and, the former mayor's office and the current mayor's office. And I'd love to see some better maps that we can share, because it's bigger than just the greenways. It's the connectivity. You just saw the 12 South Greenway piece, that was done. Well, that's an example of what a good pedestrian bike lane could look like. And if you connect that to greenways, once you get enough of that done, then people are not afraid to get on the bikes and ride all over town. And it just changes the dynamic of a city. And we could be an example for North America. Vancouver is a great example of what you can do. If you ever get to Vancouver, look at the complete street and greenway system they created. It's amazing, but we can be that too.
Love it. So anything else in the chat, guys? I'm not seeing anything. I think maybe we're going to breakout, Samira.
Yeah. And Marla, do you want to stick the breakout questions in the chat? There we go.
I know that Greenway map's in the book. I don't remember what page. It's probably in chapter 7 or 8.
Well, I love this discussion, and thank you to Abby and Andy and Deborah and Mark. It's fascinating stuff to me.
Let me know if you want to talk to David about getting a panel together.
I definitely will.
All right. So do y'all see the questions there for y'all to discuss in the breakouts? In the spirit of learning, any in the group have a success in 2023 to share with us? And then based on what we learned this morning, how are you inspired to move forward with your investments in 2024? So I will open the rooms and we'll shut them down just before 10 o'clock. Mike and Jennifer, do y'all see your breakout room invitation?